and welcome to Indianomics. While all of us have been watching the fall in the stock markets since Demonetisation Day, November 8, there has been a huge rally in the bond markets. Bond yields have fallen by 60 basis points since November 8, Demonetisation Day, and bond prices have shot up by nearly 5%. But confusion reigns supreme about the future course of this bond rally. Will the savings glut last, and how long? How much will inflation fall? How much will growth fall? How much more will RBI cut rates? To answer all these questions, I have with me Badrish Nivas, the head Global Markets Treasury at Citibank India, Anant Narayan, head of financial markets at Standard Chartered Bank, Pranjal Bhandari, the chief India economist at HSBC, and Neeraj Gambhir, managing director and head of fixed income at Nomura India. Gentlemen and lady, welcome to the show. Well, let me start with the economist. Pranjal, what's your assessment of both growth and inflation, and hence what might RBI do, not just on December 7th, but over the next 2 or 3 months?
Right. So, this is a mixed bag in the short run. Some things will benefit and some things will lose out. The efficacy of this entire demonetization drive over the long term will really depend on the sort of reforms that the government does. Now, coming to your growth question, we have to distinguish between the temporary and the long-lasting impact. The temporary is the effective fall in money supply. The fact that many people have legitimate income, but because of the lack of notes or because of restrictions in taking out money from the banks, they are not being able to use this. The more permanent and the more long-lasting impact will be the permanent wealth shock, which many people, primarily the holders of black money, will feel over time.
Yes.
We've tried to distinguish between these two, and we've used something called the cash elasticity of growth and found that growth could be lower by about 1 percentage point over the next year, with the impact being actually almost double in this quarter and next, because it's this quarter and next which is not just facing the permanent problem but also the temporary problem. Important to distinguish some small details. One is on consumption. So far the consumption story was going pretty well, and the thought was that if it continues at this rate, then the output gap, the slack in the economy, will close by the middle of 2017, and then by the end of 2017 we'll see some revival in investment. What this has done is that it's pushed this entire consumption story by a quarter or two, and at this rate it's quite possible that the output gap will only close by the end of 2017, and investment will be a story only of 2018. Now, going back to inflation.
Pranjal, my immediate point to understand is to get a handle on how interest rates and bond yields will go. So for that, I really want to know, with this combination, what do you expect from the Reserve Bank?
Right. So if growth is lower by 1 percentage point over 1 year, as I explained, then through the entire Phillips curve framework, we find that inflation could be lower by 20 basis points. Now, we were already expecting a 25 bips repo rate cut in December. We are more confident of that. And the risk is that because inflation is likely to be even lower by 20 bips, that we could see another 25 bip rate cut, following in the following policy meeting, perhaps in February. So that is the sort of rate cuts we are looking at, 25 to 50. At this point.
Point taken. I guess the bond markets are already factoring that in. So let me get the bond experts on that issue. Before I come to the inflation and the rate cut discounting, Anant, you also have to grapple with the savings glut, which is having its impact on bond yields. How are you making sense of how much of the savings will stay, and therefore how will the 10-year, for instance, move over the next 2 months?
Latha, look, lots of events happening at the same time, both domestic as well as global. In the short run, all the currency notes which come in clearly are accreting to the deposits and liabilities of banks. And we are therefore seeing banks sitting on tons of cash. The liquidity in the system has gone to a significant surplus. It will probably stabilize at lower levels in the medium run, but as of now, till December and maybe even till January, we will see a liquidity surplus. And of course, a lack of deployment avenues for banks. Already we are seeing the impact of that. We are seeing large banks reduce their deposit rates significantly. So what's going to happen in the short run is liquidity and deposits going up, banks not really having avenues to deploy this, and therefore chasing bonds and buying up all the bonds they can, deposits rates coming down, and hopefully therefore lending rates coming down as well. But at the same time, one can't ignore what is happening in the rest of the globe. The reality is, ever since the US elections came through and they sort of coincided with the demonetization drive in India as well, we've had a significant move up in the USD strength globally. We've seen emerging markets facing the shock, and in fact, currencies across the board have weakened against the dollar. And yields across the board have gone up in consonance with what's happening in the US curve as well. So we have a bit of a dissonance of domestic factors pushing down rates dramatically in the short run. At the same time, global factors looking like creating some amount of external concerns.
Okay,
and we have to...
No, I want to. Yeah, I take your point. Sorry to interrupt. I'll come to the global scene in a bit. If you can just estimate how you will look at the savings problem that is hanging on banks' hands, and therefore, as a bond expert, how are you going to look at bond yields over the next 60 days or 90 days?
I think the way it will play out, Latha, and I could be completely wrong, but I think the way it could play out is, given the overhang of domestic factors, which is going to really weigh on the monetary policy and, for that matter, the fiscal outlook as well, we are going to see aggressive rate cuts. I think the bond market is factoring in the possibility of a 50 basis point rate cut in December, followed maybe even more by a 25 basis point rate cut in the first quarter as well. All this could be justified given the savings glut, liquidity glut, deposit growth coming through, and therefore the impulse on deposit rates. That could play out. Having said that, I can't see the rally in 10-year bond yields, for instance. It's already reached pretty close to our target of 6% on the 10-year. It's bounced back a bit today. Longer tenor bond yields sustaining at very low levels doesn't seem to make sense. After all, what we are going through is a temporary shock on liquidity and deposits. Things should equalize and normalize in the medium run. What, therefore, I sense would happen is the bond curve should start to steepen. You could see 10-year bonds rally, because of the rate cuts and because of the liquidity glut, to even below 6% in the short run, maybe to 590 levels. But frankly, I would be wary of those levels sustaining in the medium run. Okay. I would rather think that the short-end rates can come down to maybe 575 or so, but longer and 10-year bond yields below 6% don't quite make me comfortable. Okay.
Well, that's most helpful, Anand. We have a lot more impulses, of course, to factor in. But Neeraj, a similar question to you. Say by Jan or by Feb, where will you see the overnight rate? Where will you see the 10-year, and why?
Well, I think the overnight rate will obviously react to the rate cuts, because what currently Reserve Bank is doing is sucking out the entire liquidity by way of reverse repos. So unless and until the fixings on the reverse repos come down, the overnight rate will pretty much be close to the reverse repo rate. As far as the longer end of the curve is concerned, the 10-year bond yields, I think the important thing here is that banks are very uncertain at this point in time as to what percentage of the liquidity that they're getting today is going to stay with them for a longer period of time. What I am picking up is that a large part of this money is actually coming in the form of current deposits, and the uncertainty around the longevity of the current deposits in the system is quite high. It's dependent upon the pace of new currency creation by Reserve Bank. So what the banks are currently doing is simply parking this money as reverse repos with RBI. I haven't seen a large amount of this money going into the bond market as yet. What the bond market has done is basically anticipated the net impact of this and actually rallied. Now the question is that from here onwards, once the flow of money stabilizes, once we see some kind of semblance of stability in the pace of net liquidity generation in the system, what percentage of this money banks will actually invest in the bonds? I kind of agree with Anand that, anything less than 6% in terms of bond yields, given the anticipation of a 50 basis point rate cut by RBI over the next 3 months or so, looks a little difficult to sustain. But I would not be very surprised if, given the amount of liquidity that banks have, and given the fact that there are very few avenues for this to invest right now, and also banking system has a capital constraint, if the banks are forced to invest this money into the government bonds for some period of time. So, going below for 6% is feasible. I'd say even 575 is feasible, but it depends upon how sustainable this liquidity is in the system. I don't think anybody has a great amount of clarity around that as yet.
Okay. No, I agree. We do not know how long the money will stay, because we do not know by when the currency crunch and therefore the cash withdrawal limit will remain in place. Badri, to introduce the element that Anant brought in, there is also a Fed event on December the 15th. So given that, what is your best guess of what the Reserve Bank might do? And therefore, if you have to play the 10-year for February, how will you?
Sure. So, Latha, from here on, much of what happens on the bond yields will depend upon what RBI does, both in terms of their liquidity mopping operations as well as in terms of the policy. First, on liquidity mopping operations itself is right now they've restricted their liquidity to taking out of the system to reverse repos overnight and some small short tenors. They have about 7.5 lakh crores of government securities on their balance sheet. At some point, the risk is that they could run out of it. So I'm sure they're trying to see what other tools they could use if even on the short time period you have more liquidity. So I would assume that they would look at things like MSS bonds, etc., which could be tools. Now what tenor they come up with will give us some indication also of what they think about how enduring this liquidity could be. I think if they come for tenors like 1, 2, 3 years, for example, then you could get some backup in yields. It would provide banks with deployment opportunities. And
that may be wishful thinking. It's quite possible they'll come with 91 days.
If it's going to come for only 60, 90 days, then to that extent, then the whole biddishness on bonds will probably continue because banks will look at deployment option. Before I come to the policy, on this whole, how long this could stay, exactly. I think a lot of it will depend upon what the government's plans also going to be. At the end of the day, today morning we saw, the Prime Minister talk about the digitization and the fact that we need to move towards a cashless economy and stuff. So if the government has, more sustained plans about how they should drive the whole economy towards a cashless economy and therefore come with certain incentives, disincentives, whatever it takes to ensure that, the banking channels and digital channels are more used and we use this opportunity to reduce the overall cash economy in a more longer term basis, maybe some of these monies could stay actually for longer periods of time. So I think a lot of balls are in the air and a lot would depend upon policy actions both by the RBI and the government. To your question on the rate cut itself, right? I think if you put yourself in the shoes of the MPC on 7 December, clearly, they would also see that private forecasters are dropping economic growth. They themselves would have to take a call in terms of how much of a shock this will give to the economy and would that be sustaining and so on. My guess is that they would definitely have to be very dovish and actually kind of prepare the market and say that they would be acting very decisively if the growth downturn is more sharper and more enduring. But whether they will have the information as of 7 December to take those calls, I would be a little surprised. So I would be saying that they may do a 25 basis points cut, even though it will be a little bit of a close call. But I think they would sound a lot dovish. But whether they would act with a lot more, aggressiveness, I think they might want to hold their, bullet, so to say. Absolutely. Especially given that you've already seen a bit of transmission and deposit rates come down. I think the other challenge for them for aggressive rate cuts will come in terms of how they want to handle the dollar rupee and what happens to dollar rupee. Okay.
Let's handle the dollar rupee in a minute after the break. After the break, we have actually 2 or 3 important things to handle. The Reserve Bank policy will be the first official comment from the government as to where they see growth. It will also be the first time we will hear about what they think of how long the savings might last. So what are our experts expecting from the Reserve Bank? That question to our guests in a minute after this break.